NASDAQ 100 is pacing for its fourth straight positive week. That's the first time since October. The growth IWF, that's the growth ETF, 10 of 11 sessions it's been up. Is the growth trade back?
I think it's back, although I wasn't saying that it was gone. So I think what we're seeing here is, first and foremost, obviously the 10-year calming down, moving back into a pattern, setting some parameters around what we can expect. We're clearly seeing out of the Fed that they don't intend to make any real moves, despite the fact that we're seeing some increases in inflation, and certainly they're viewing that as transitory, and so should we. But if you look at what has happened over the last few days, it's that everybody's come back around to the story that stronger economic growth is going to lend itself to greater enterprise spend for businesses. What we've seen is that this has just accelerated the need for businesses to become more technologically advanced. And so if you look at what's driving this rebound in growth, it is anticipated higher enterprise spending. I don't think that's going away. So although we certainly are moving back into more of a, perhaps hybrid working model, there's going to be many people going back to work over the course of the next several months. Companies have realized that they can be much more efficient through the use of technology over the last year because they were forced to realize those efficiencies. That's going to continue over the next couple of years. Barbelling your portfolio with some traditional cyclicals as it relates to the infrastructure trade or the overall global manufacturing rebound we have with this, big tech, quality tech trade, I think is a great way to position yourself over the next couple of quarters.
Yeah, look, Steve Weiss, the number of notes that have come out over the last few weeks, if not few months, saying it's all about value. We're all in on the value trade. We like the cyclical trade. We like the recovery trade. We like the reopen trade. Now you have this growth rebound. The Russell 1000 growth is up 7.5% this month. Value's up 3.5%. The 10 years obviously helping all of this sort of shape the narrative that we're putting forth today. But do you think this bounce back in growth, and I think it's fair to call it a bounce back because value had been leading, is it for real?
Yeah, and it is a bounce back. And like Shannon, I didn't think the fundamentals ever changed. I thought they were always strong. So I do think it's real. And what we're seeing is more dispersion across stocks, across sectors. So I think it can stay, and I think it can coexist with value, with cyclical. But then again, to your point that you made in the question, it also depends upon rates. So if you see a huge spike in rates again, you'll have the quants come out and they'll say, long dated on my relative value screens, I've got to sell tech, I've got to sell growth, and I've got to buy value. Now, as I said, there's great dispersion. So you're not seeing the major uptick in the names that really were like the super high flyers, such as the Zooms or the Teladocs. Yeah, maybe there's a tick up in there, but the market's being more discriminating. It's also seeing a rotation underneath the indices. So the VIX belies what's actually happening. Take small cap growth, where a small cap typically leads up and down. We're seeing that's a lagging indicator to what happened to big cap growth. So, for example, some of the names I own, like a Vuzix or a Jumia, they're down. But nothing's changed in the fundamentals. You're in a quiet period. So the question is, how long can that last? So I do think you have to reposition to a certain extent. You have to go where the economy is going, which is going to continue to use the chip stocks, but also typical, cyclical, economically sensitive. So yes, it can coexist with growth, but you've got to be more selective.